Living off passive income is entirely possible, but the version of it you usually hear about is frankly a lie. The internet loves to sell the idea of making money while you sleep, painting a picture where you buy a few assets, set up a funnel, and then spend the next 40 years drinking margaritas on a beach while cash magically appears in your checking account. In practice, true hands-off passive income is fragile, incredibly expensive to buy, and far slower to build than anyone admits. For the vast majority of people who actually achieve financial independence, the reality isn't zero work. It is a messy, evolving mix of investment, withdrawals, semi-passive side hustles, and active management. Today, I want to take apart the math, the risks, and the psychology of living without a paycheck, because if you build this wrong, you don't just lose income. You lose your freedom. Before we dive into the spreadsheets, I want to make sure you stick around for the second half of this breakdown, because that is where we get into the psychology of why people with $3 million in the bank still panic about spending $5 on coffee. It is a real problem. Also, if you appreciate deep dives that respect your intelligence and your wallet, go ahead and hit that subscribe button. It is the best return on investment you will get all day. In plain terms, living off passive income just means your assets generate enough cash to cover your bills without you trading hours for dollars. This usually comes from two main buckets. The first is the cash flow model, like dividends or rent. The second is the total return model, where you sell off small pieces of your portfolio over time. Most people fight over which is better, but the smartest people I know usually end up using both. Let's start with the math behind the phrase never work again. If you have been in the financial independence space for more than 5 minutes, you have heard of the 4% rule. This is the classic rule of thumb derived from research by William Bengen. It suggests that if you invest in a diversified portfolio of stocks and bonds, you can withdraw 4% of that portfolio in your first year of retirement, adjust that dollar amount for inflation every year after, and have a very high probability of not running out of money for at least 30 years. The inverse of 4% is 25. That gives us the quick napkin math everyone uses. Your target portfolio needs to be 25 times your annual spending. So if you spend $40,000 a year, you need $1 million invested. If you spend $80,000, you need $2 million. It sounds simple enough on the surface. Here is where the math gets messy. The 4% rule is not a guarantee, it is a probability based on historical U.S. market data. More recent research, specifically from places like Morningstar, suggests that in certain economic environments, especially ones with high valuations and low bond yields, a 4% withdrawal rate might actually be too aggressive. They have argued at times for something closer to 3.3 or 3.7%. That might sound like a tiny difference, but let's run those numbers. If you need $40,000 a year to live, and the safe withdrawal rate is actually 3.5%, you do not need $1 million. You need closer to $1.15 million. That is an extra $150,000 you have to save just to generate the exact same lifestyle. Remember, this model isn't technically passive income. In the traditional sense, you are selling assets. You are slowly liquidating your position, betting that the remaining money grows faster than you can spend it. The other trap in this math is inflation. People often say, I have $1 million, so I can pull out $40,000 forever. But $40,000 today buys a lot less than it did 10 years ago. If inflation runs at just 3% in 20 years, you will need roughly $72,000 just to buy the same groceries and pay the same utility bills that cost $40,000 today. If your passive income is fixed, say from a corporate bond or a non-adjusted annuity, you are effectively getting a pay cut every single year. This is why the total return model is so popular. Stocks have historically outpaced inflation, acting as a natural hedge. If you rely purely on fixed income, you might feel safe in year 1, but by year 15, you could be living near the poverty line without realizing how you got there. So what is the protocol here? If you are building a withdrawal-based passive income plan, you need a margin of safety. Do not plan for the best case scenario plan or the boring and mediocre scenario. Many experts suggest aiming for a withdrawal rate between 3.5 and 4%, but retaining the flexibility to cut your spending if the market tanks. If you can live on 3% of your portfolio during bad years and 4% during good years, your chance of success skyrockets. The math tells us that flexibility is actually more valuable than just having a bigger pile of cash. It's about not being forced to sell when the market is down. Now, you might be thinking, I don't want to sell my stocks. I want pure cash flow. I want rent checks and dividends that just show up so I never have to touch the principal. That is the dream. But if you think the stock market math is tricky, wait until you see the trap waiting for you in the world of pure cash flow. This is where most people underestimate cost by about 50%. The cash flow model is what most people visualize when they say passive income. The idea is that your assets pay you directly. You own 10 rental units, netting you $4,000 a month. You own a massive dividend portfolio, sending you you quarterly checks. You have royalties from a book you wrote 5 years ago. In this model, the principle, the golden goose, is never touched. You just live off the eggs. On paper, this feels infinitely safer than the withdrawal method because you aren't selling in. You still own the house. You still own the shares. If the market crashes, you theoretically still get your rent check. It feels tangible. It feels robust. And that feeling of safety is exactly why so many people rush into it without doing the due diligence. Here is the trap. Revenue is not income. I see this constantly with real estate. Someone buys a duplex and says it rents for $2,000 a month. So that is $24,000 a year in passive income. No, it is not. That is gross revenue. From that, you have to subtract property taxes, insurance repairs, vacancies, management fees, and capital expenditure, like a new roof every 20 years. Once you strip all that away, your net passive income might be closer to $600 a month, not $2,000, and that is before income tax. To replace a $40,000 salary with net rental income, you don't just need 1 or 2 houses. You might need 10 or 12 units, free and clear. Suddenly, you are not a passive investor. You are a property manager with a very expensive hobby. Real estate is scalable, but it is rarely truly passive, unless you are paying a management company, which cuts into your margins even further. The psychological twist here is that we tend to undervalue our own labor. When you are managing your own rentals or chasing high-yield dividend stocks, you are often just buying yourself a job. If you spend 10 hours a month dealing with tenants, coordinating repairs, or researching which high-yield stock isn't a value trap, you are working. It might be better than your corporate 9 to 5, but it isn't passive. The IRS might classify it as passive income, but your calendar will disagree. I have spoken to plenty of landlords who reach their freedom number only to realize they just traded a boss they hated for 20 tenants who call them at midnight because the toilet is clogged. True passivity comes with a price tag, usually lower returns, in exchange for professional management. The solution isn't to avoid cash flow assets, but to treat them as a stabilizer, not the whole engine. Most successful early retirees I know use a hybrid model. They have a core portfolio of index funds for long-term growth withdrawals, and they layer in some cash flow to cover the basics. For example, maybe your rental income covers your groceries and utilities, the absolute essentials. That way, if the stock market crashes, you know you can still eat and keep the lights on without selling shares at a loss. You use the reliable semi-passive income to lower the stress on your portfolio. You don't need the cash flow to cover everything, just enough to let you sleep at night. Now, we have looked at the income side, but there is a variable in this equation that is actually 10 times more powerful than your investment returns. Most people obsess over how to earn an extra 1% on their portfolio, but I am going to show you why cutting your expenses by 1% is actually worth double that in terms of freedom. This is the part of the equation where you can cheat the math. The critical variable is spending, not income. Financial planners often use a formula to determine your freedom number. It is your annual expenses multiplied by 25, assuming that 4% rule holds up. This means every dollar you spend requires $25 of invested capital to support it forever. Think about that. That monthly Netflix subscription isn't just $15. It represents $375 of capital you need to accumulate and keep invested essentially forever. A $500 car payment requires $150,000 in your portfolio just to sustain that one line item. When you view your expenses through this lens, the cost of luxury isn't just the price tag, it's the years of freedom it costs you to accumulate the backing capital. A great way to track this without getting overwhelmed is the passive FI ratio. This is simply your passive income divided by your expenses. If you spend $40,000 a year and have $10,000 coming in from dividends or side projects, your ratio is 25%. You are a quarter of the way to freedom. What's interesting is that the progress isn't linear. The first 10 or 20% is the hardest, but it is also the most impactful. Once you have enough passive income to cover just your rent or mortgage, say 30% of your expenses, your risk tolerance changes completely. You don't need to be at 100% to feel the benefits. At 50% coverage, you could technically take a job that pays half as much, but is twice as fulfilling. You are no longer working to survive, you are working to thrive. The psychological trap here is lifestyle creep, or what I call the moving goalpost problem. I see people hit a net worth of $500,000, which was their original goal, and suddenly they decide they need $1 million. They hit $1 million, and now they need $2 million because they want a boat and business class flights. If your spending rises in lockstep with your passive income, you never actually get free. You are just running on a faster treadmill. The people who actually pull this off are the ones who can freeze their lifestyle in place. They decide what enough looks like, and they ruthlessly defend that number against marketing, peer pressure, and their own ego. The protocol for mastering this is to focus on the gap. The gap is the difference between your income and your spending. Your savings rate is the single biggest determinant determinant of how fast you can retire. If you save 10% of your income, it takes decades to reach independence. If you can save 50% or more, you can compress that journey into 10 to 15 years. Sounds extreme, but it is just math. Every dollar you don't spend is a double win. It is one more dollar added to your portfolio, and it is one less dollar you need your portfolio to generate in the future. Attack the spending side first. It is the only variable you can control completely. Today, we need to talk about the monster in the closet. The one thing that can destroy even a perfectly calculated passive income plan. It's called sequence of returns risk. If you ignore this, you could do everything right. Save the money, buy the assets, quit your job, and still go broke within 5 years. It all depends on what the market does the day after you give your 2 weeks notice. Sequence of returns risk basically says that the order in which your investment returns happen matters just as much as the average. Let's say you expect an average 7% return over 30 years. If the market crashes 20% in the first 2 years of your retirement, while you are also withdrawing money to live, you dig a hole so deep that your portfolio can never recover, even if the market booms later. You are selling shares at rock bottom prices to buy groceries. This permanently depletes your capital base. Conversely, if you get a bull market in your first few years, you are practically invincible. It is luck of the draw, and it is terrifying because you cannot predict it. Let's run the numbers on a bad sequence. Imagine you retire with $1 million. In year 1, the market drops 20%. Your portfolio is down to $800,000, but you still withdraw your $40,000 to live. Now you have $760,000 left. In year 2, another 10% drop. Your portfolio shrinks again, and you take out another $40,000 plus inflation. Suddenly, you have burned through nearly a third of your money in 24 months. To get back to even, the market would need to go on a historic tear, but you have less capital working for you to catch that ride. This is why standard average return calculators are dangerous. They assume a smooth ride, but the market is a roller coaster. The psychological component of sequence risk is panic. When you see your life savings drop by 20% right after you quit your job, the instinct is to stop the bleeding. You want to sell everything and go to cash, but selling at the bottom is the financial death blow. It locks in the losses. Navigating this requires a level of emotional discipline that most people simply do not have. It is easy to be a long-term investor when you have a paycheck coming in. It is agonizing when your portfolio is your only lifeline. This is why many retirees fail. Not because the math broke, but because their nerve broke. The protocol to fight sequence risk is the cash buffer or bond tent. The idea is to keep 1 to 3 years of living expenses in cash or short-term bonds when you first retire. If the stock market crashes in year 1, you don't sell a single share. You spend your cash buffer. You live off the savings account and let your stocks recover. Once the market bounces back, which historically takes a couple of years, you replenish the cash buffer. This acts as a shock absorber. Yes, holding that much cash drags down your long-term returns slightly, but it buys you insurance against the worst-case scenario. It ensures you never have to sell a stock when it is down 20% just to buy a sandwich. We have covered the money, the risks, and the math, but there is one final hurdle that almost nobody talks about until they hit it face first. It is the reason why so many people achieve financial independence and then go back to work within 18 months. It has nothing to do with inflation or stock prices. It's about what happens to your brain when the alarm clock stops ringing. There is a distinction in the FIRE community between retiring from something and retiring to something. If you are just running away from a job you hate, you will likely crash and burn once the initial euphoria wears off. A week at the beach is paradise. A year at the beach is a crisis of purpose. We derive a huge amount of our social status, social circle, and sense of utility from our work. When you strip that away abruptly, you are left with a void. I have seen financially independent people spiral into depression because they underestimated their need for structure and challenge. The myth is that humans are designed for endless leisure. We aren't. We are problem-solving machines. Without problems to solve, we invent them. You might find yourself obsessing over the lawn or arguing with strangers on the internet just to feel some engagement. The most successful passive income earners don't actually stop working. They just stop doing work they hate. They shift to optional work. Maybe they start a passion business, volunteer, or consult on their own terms. The goal of passive income shouldn't be to do nothing. It should be to have complete autonomy over what you do. This brings us to the concepts of lean FI versus fat FI. Lean FI is where your passive income covers a bare bones existence. You can survive, but you are counting pennies. This is stressful and fragile. Fat FI is where your passive income covers a luxurious lifestyle with room to spare. Obviously, fat FI is safer, but it takes twice as long to reach. The sweet spot for many is a mix. You reach a baseline of financial independence where your survival is guaranteed by passive income, but you continue to do some form of active work to fund the luxuries and keep your brain sharp. This takes the pressure off. You don't need the job to eat, so the job becomes fun again. It changes the power dynamic completely. So the final protocol is to design the life before you design the portfolio. Don't race to a number and hope happiness is waiting at the finish line. Start building the life you want now. Test drive your retirement. Take a sabbatical if you can. Develop hobbies that don't involve consumption. Build income streams that align with your interests, not just your bank account. If you can build a life you don't want to escape from, you might find that you don't need as much passive income as you thought. You just need enough to buy your autonomy. To wrap this up, can you live off passive income? Yes, but stop looking for a single magic bullet. It is an ecosystem. You build a foundation of low-cost index funds to capture global growth. You layer in some semi-passive cash flow, like rentals or dividends, to provide stability. You keep a cash buffer to handle the bad years. And most importantly, you keep your skills sharp and your options open. The most secure people aren't the ones with the biggest pile of money. They are the ones who are flexible. They can scale their spending down or scale their income up, depending on what the world throws at them. I want to hear from you. In the comments, are you aiming for a total withdrawal strategy? Or are you a diehard cash flow believer? Or do you think the whole concept is overrated? Let me know your freedom number if you're brave enough to share it. If you found this useful, hit the like button. Thanks for watching, and I'll see you in the next one.